This is the voice of Warily, and this lecture for you all now is going to cover VWAP, the institutional meme average. VWAP is one of my favorite tools to use. It is extremely versatile and great for building context around both momentum and reversion trade ideas. Expanding on the title, specifically the institutional element, will become more relevant of a task as we breach further into the lecture, but for now suffice to say that whilst it's true a lot of quality market participants evaluate VWAP, there is a lot of misinformation around it, most of which will either get your account chopped to zero or outright liquidated. The primary objective of this lecture is to educate on a more sophisticated and logically sound perspective of VWAP and offer an example trading framework based on that. Before we start, like and subscribe, also follow me on Twitter and join the free Discord, the link to which will be in the description below this video. A brief overview of the lecture is as follows. We will begin, as always, with some general remarks and disclaimers. Afterwards, I will talk a bit about some of the platforms I use to execute my trades. Following that, we will give an overview of VWAP, its anatomy, some myths around it, what it actually is, and its different types. Afterwards, we will explore some fundamental theory that will be required for context within the VWAP trading framework that I'm going to share with you all today and that I use every day. We'll have 8 biases to go over and examples of each of those, and then we'll wrap up with some closing thoughts and a conclusion. General remarks. First, I'm not a financial advisor. This video is for entertainment purposes only. Otherwise, I want to make it clear that VWAP is a tool that is best used as a piece of confluence, not as a singular reference point. There is no one-size-fits-all trading system, and VWAP does not fill that void. Trading is an art as much as it is a science. You do not have to and should not trade every setup that stems from the framework I'm going to provide. The best trades are done by executing discretionarily based on an understanding of the context and in having established a probability skewing system. In that, I want to emphasize that in this business, we work with probabilities, there are no guarantees, and anyone telling you otherwise is lying to you. Briefly, some things I use in my trading system that are relevant to this video. TradingView, if you're watching this video, you've likely already heard of it. Atos, which I'll have a dedicated video for, is an order flow based charting platform with execution capabilities. It is completely free for crypto, but does provide a paid plan to use it for trading legacy markets, and I particularly like their footprint charts. MEXC is a popular exchange to trade crypto, and I like to recommend it to experimenting low time frame traders by virtue of the extremely low fees. As we talked about in the high probability scalps for beginner traders video lecture, fees are definitely something to be aware of, especially in crypto and especially for low time frame traders. Apex Funded is an online prop firm that allows for access of up to $300,000 accounts of someone else's money to trade with if you pass an evaluation. The trading framework I cover in this video can be used in any market, but I find it works especially well in crude oil and indices, all of which can be traded with Apex Funded accounts. If you want to be evaluated, you can use my code on screen at checkout or click the affiliate link in the description. There is currently a 71% sale on evaluation accounts and resets. There are always sales using that link, but this one in particular will last until November 28th. Carrying on, understanding the anatomy of VWAP is going to be important. On the right side of this image, you can see color-coded levels to their respective line or area. In the orange line in writing, we have VWAP itself. The blue area nearest to VWAP encompasses the value area, or the first positive and negative standard deviations of VWAP. The purple lines and the codes are relevant to the second positive and negative standard deviations of VWAP. Similarly, the green lines and codes are reflective of the third positive and negative standard deviations of VWAP. The 2 yellow circles mark out resets in the VWAP. We'll talk more about the types of VWAP in a moment, but essentially, VWAPs that encompass a set time period, in this example a weekly, will reset after that time period and begin building out a new VWAP. Again, you can see those areas marked out in these yellow circles. The reason why one area is denominated by a brown 1 and the other in a red 2 is to showcase that the standard deviation bands essentially act as a measure of volatility in a given period. The wider the bands are in relation to VWAP, the more volatility was experienced in that period, whereas tighter bands reflect a lower volatility environment. One thing I want to take a moment to mention before we move on is that unlike something like an RSI, for example, where there are tons of different factors that adjust its values, the look-back period, the moving average type, for example, with the VWAP, there's no tampering and obsessing over the optimal settings for different markets and timeframes. It is largely plug and play, which is one less thing to have to worry about getting right. There are a lot of myths around VWAP and how to use it. The two most popular trading strategies offered by your typical clickbait red arrow educators are: first, wait for price to trade above VWAP and long on retests, or wait for price to trade below VWAP and short retests. This approach often leads to traders getting chopped out, as price trading at VWAP is a reflection of price resting in an area of value and is not expected to migrate from that level, especially if it has been trading tightly to it before the so-called signal. The second approach is offered as fading moves away from VWAP with the expectation that price will mean revert back to VWAP. So to say that you would wait for price to trade far above VWAP and short it back to VWAP. Or wait for price to trade far below VWAP and long it back to VWAP. This methodology is extremely dangerous, as one violent trend could easily end in liquidation. As an example of the first setup, we can look on the left side of this image. Here you can see that price trades above VWAP, retests it, and then continues to chop. An example of the second setup can also be seen here. It's a little bit more clear, where price begins trending upwards. Assuming you're catching local tops, you may short it here with the expectation that price will revert back to VWAP. However, price continues in an upward trajectory, placing another swing high, so you average in despite the drawdown, and once again this assumes that you're catching highs, but then price proceeds its trend with a return to value as the expectation. The trader will then continue to average in, and finally we get this blow off top, which ends in your account essentially turning to dust. Despite the risk, the second methodology has some logical basis, as VWAP is a great tool for mean reversion, but we need a great deal of fine-tuning to make that theory actionable, which is what we will focus on in this lecture. Although we will briefly touch on the context by which the first methodology stems from. So what is VWAP? VWAP is the common abbreviation for the volume-weighted average price indicator, and is calculated by taking the product of the summation of price times volume divided by the summation of volume, where price is achieved as the common HLC3 formula, and although it's unnecessary, that is often modifiable, and volume is typically taken as the number of contracts traded. Essentially, VWAP is a moving average that attempts to establish fair value and its surrounding value as an interaction between volume and price. This relationship gives VWAP inertia, which adds another layer of significance compared to that of a traditional moving average that only accounts for price fluctuations. Also important to note is that using this relationship between volume and price is what leads to the institutional element of VWAP being thrown around for attractive titles, but you are never really told what the relevancy is. Essentially, as we discussed, VWAP justifies itself as fair value by, unlike standard moving averages, of which VWAP is commonly associated, it is largely unreactive to anything besides moves that come in conjunction with relatively high volume. In other words, VWAP justifies itself as fair value based on only reacting to highly involved activity in the market, and thus being positioned to filter out a great deal of noise. This is crucial to large traders working at brokerage firms who come to tasks of accumulating X large number of shares towards a particular asset position in a set time frame, as VWAP is often applied as a benchmark to assess execution quality. This is so on the basis of asking the question, was accumulation achieved at a price better than fair value, as being the same thing as asking, did the execution beat VWAP? VWAP is a great tool for use as a measure of value and as a dynamic key level. Of course, we will cover those principles more in depth throughout the lecture. Some types of VWAP are as follows: the traditional time frame VWAPs, the daily or session, as I refer to it as, the weekly, monthly, quarterly, and yearly. If you trade markets with a lot of price history, you can also consider using the decade VWAP for an extremely high time frame context. These types are designed to establish VWAP within their time frames and reset to rebuild when the time frame restarts. As an example, a monthly VWAP will develop with price from the start of the month until the end of the month, after which a new monthly VWAP will begin to form for the new month. You can see how the daily through the yearly time frame VWAPs interact with recent price action on the Bitcoin daily chart to the right. Each measure of VWAP is color-coded in accordance with the highlights on the left side. The exception is this white VWAP, which is next on our list. That is the anchored VWAP. This type establishes VWAP from a reference point of a specified candle. It is most often applied to major swing points. In the example on the right, it is applied to the Bitcoin all-time high. You can't see it on the chart, but the white line runs from the Bitcoin all-time high until current price action. Another effective, albeit less common, application of the anchored VWAP is to stem it from price reaction to key events. For example, FOMC meetings and economic data reports, as well as major macro news headlines or asset-related headlines. This sort of thing obviously requires a bit more discretion, but something important to consider is that not all events are created equal, and if price is unreactive to the event, anchoring VWAP to it will be much less effective. The final VWAP I don't personally use. This type is a rolling VWAP, which measures VWAP in a constant look-back period. For example, a rolling VWAP set to look back 1 hour will establish VWAP based on the defined reference point of an hour ago through to developing price action, and will continue to do so as time rolls forward without resetting. I also want to take this moment to distinguish a VWAP from the VWMA, or the volume-weighted moving average, which for some reason no one ever talks about. But the VWMA can essentially be chalked up as a rolling VWAP that only accounts for candle closes, as opposed to cumulative price, which in my opinion makes it less significant. Our discussion of the relevant VWAP theory will be divided for understanding in 3 parts. First, understanding VWAP and its bands as a value area, which I will often abbreviate as VA. Second, the probabilistic expectations of VWAP as a value area, along with the 5 principles of that. Third, we will investigate the relationship between price action and VWAP structure to form our bias for an example trading framework that uses all of this theory. Value areas in trading are price ranges in which 68.2%, often just chalked up to 70%, of activity was conducted during a specified period of time, with the remaining distribution being referred to as axis. Activity in this context is just going to be profiled as the relationship between price and volume and or time. For our purposes, we will define 3 levels that form as a result of having established a value area. We can see that in the diagram on the right, where the center line in orange is the POC. This is the exact fair value of a value area by virtue of it being the highest activity node in the distribution. Given that it is fair value, price tends to this area and is expected to chop around it. This is how we will interpret the VWAP. Above the POC, we have the value area high, or the VAH. In accordance with our VWAP framework, this will be the first positive standard deviation, which I'll notate as +1. And coming into this level, price is expected to rotate to lower regions of value. If you're thinking about price action, this is essentially a range high. The inverse of that, what we'll use as what will essentially be our range low, is the value area low, or the VAL. In accordance with our VWAP framework, this will be the first negative standard deviation, which I'll denote with a -1 of a VWAP. Coming into this level, price is expected to rotate to higher regions of value. Now that we have defined VWAP as a value area and some basic insight to how value areas operate, we can get a bit deeper into the 5 basic principles of value areas. First, if price accepts into one end of value, it is likely to rotate towards the other end, and we can see an example of that here. Each of these 5 principles have their own diagram. In this case, price often retests the end of value it is accepted from before this rotation. So in the first diagram, we see price rotates into value from the value area high, which would mean that we are likely to get a retest of value area high before rotating lower through value. The second principle is that price inside of a value area is expected to rotate between each end of value, essentially chopping the value area with the most activity at the POC. You can see that here in the second diagram. Our third principle is that price acceptance outside of value is likely to result in a search for new value. Oftentimes, that means price will rotate to an area of previous value. The third diagram, we can see price rotating outside of the value area low, where we retest the value area low and then continue lower, likely in search of previous value areas. The fourth principle is that strong reactions from POC are likely to lead towards a rotation outside of value. Often this is the case when price retests a naked/virgin point of control, or if price breaks away on a very strong trend before retesting. A naked POC or a virgin POC, often denoted as NPOC, is just an untested point of control from a previous value area. untested meaning we broke out of a value area and never came back to retest the POC of that value area. The fifth principle is acceptance at one end of value is likely to result in a rotation outside of value. And in this case, we typically justify acceptance as a time or price buildup. Here you can see that price rotates from the value area high of our value to the value area low, where we put in some time acceptance. Price doesn't really move away from the value area low, and eventually it breaks down through value area low. Once again, likely in search of previous value. Now that we've established that, we can lean on the relationship between price action and VWAP to finalize our understanding of how to curate a market bias with this baseline. The first thing we'll look at is pretty simple. If price is generally making higher highs and higher lows, the market is considered to be trending bullishly. If price is generally making lower highs and lower lows, price is generally considered to be trending bearishly. This is the price action aspect of our price and VWAP relationship. Second, the slope structure of VWAP. In times that VWAP is postured up, we are viewed as being in a bullish environment, whereas a downward posture is reflective of a bearish environment. If VWAP is flat or sideways, the expectation is set towards a ranging market. The third aspect that we'll consider is that if price is above the first standard deviation of VWAP, the environment is bullish, as we are expected to explore potential areas of value higher. If price is below the first negative standard deviation of VWAP, the environment is bearish, as we are expected to explore potential areas of value lower. Lastly, if price is accepted inside of VWAP, we are expected to rotate between the extremes of value. Finally, it is time to put all this together. Remember, going into this, our general remarks, trading is an art as much as a science, and there is no one-size-fits-all trading system. The value in this framework will come from adding other aspects of Confluence and learning how to execute. That said, we are now going to explore a stripped-down version of a VWAP trading framework that I use every day and that is used by extremely significant players every day. The reason large traders tend to gravitate towards value areas, which we've established VWAP as being, relies on that it typically offers relatively abundant access to the counterparty liquidity necessary to execute with relatively large size, whilst also being a reference point to determine execution quality. This framework allows us to view the market from a lens of establishing a realistic expectation as opposed to an idealistic roadmap. Theory aside, the actionable premise I'm going to build on for this framework is value migration based on value area interaction. The required tools for this are, of course, VWAP, as well as the first positive and negative standard deviations of VWAP. You can access these tools easily in TradingView and pretty much any charting platform. I can't imagine that there's a charting platform without VWAP. The positive and negative standard deviations, though, some platforms might exclude that, but on TradingView you can access them easily. Some optional tools that we didn't discuss in this lecture, but that are quite powerful, are the volume and or market profiles. Granted, they require a bit more discretion, but these are what I use to establish previous value area. You can also use the second and third positive and negative standard deviations of VWAP. For adding confluence to our trade and creating actionable entry triggers, based on my system, I recommend things like the depth of market, delta, oscillators. For oscillators, I personally prefer cumulative volume delta. You can also use volume. Specifically, I like this analyzed through the lens of relativity. And in crypto markets, I also like to use open interest and liquidation. Quite frankly, though, you can use pretty much anything that you want and that plays a role in curating an understanding of momentum. We're going to view this framework in the light of 4 steps. First, we'll look at the previous value area, or PVA, and the examples that will just be the previous VWAP to establish context for our developing value area, or DVA, the current VWAP, using our value area principles. We'll then look for a pullback to our level, followed by a shift in momentum, which upon seeing will trigger a trade entry. Here is a cheat sheet for the framework that we're going to use. This is all the setups that the theory that we went over in this lecture brings us to. In each of these diagrams, our PVAs are going to be reflected in a green, orange, and red line, the first positive, the VWAP, and the first negative respectively, whilst the blue, yellow, and purple lines will signify those levels respectively for our DVA. Once again, PVA is just previous value area, in this case, just the previous session VWAP. And our DVA is just the developing VWAP or the currently active VWAP. So right into the setups. Setup 1 shows price trading above the PVA and the DVA. From our principles, we know that this gives us a bullish trend bias from both areas. Price returning to our DVA high area is a good premise for getting long in this situation. For all of these examples, if our PVA and our DVA levels align, it is indicative of a better signal as we have more confluence. Setup number 2 also shows price trading out of the PVA, but in this case we are bouncing from the DVA's first negative, where we expect price to rotate at least to the DVA mean. Setups 3 and 4 are just setups 1 and 2, but flipped, where we have created a short bias from trading below the PVA. In setup 3, we are looking for a bearish trend as we reject from the DVA's first negative one. And in setup 4, we are looking for a bearish mean reversion as we reject from the DVA's positive one. Setups 5 and 6 also both give us a bearish bias. In this case, we're looking for a bearish reversion bias from trading between the PVA mean and the PVA's first positive. In setup 5, we are looking for a reversion into the DVA mean after rejecting from the DVA's first positive. And in setup 6, we are looking for a reversion to the PVA's mean after rejecting from the DVA's first negative. Setups 7 and 8 are the opposite of 5 and 6, and we now have a bullish bias as a result of trading between the PVA mean and the PVA's first negative. In setup 7, we are looking for a reversion to the DVA mean after bouncing from the DVA's first negative. In setup 8, we are looking for a reversion to the PVA's mean after bouncing from the DVA's first positive. Now I know there was a lot of jargon in that, so please rewatch this video, this portion of the lecture, as many times as you need before we move on to the examples on the next slide. This is critical. This is everything we've been building towards. You have to understand this. This is the framework. If you want this cheat sheet so that you can have it up next to you while you're going through charts and practicing identifying these setups, you can join the Discord that is linked in the description. And like I said, I'll just give you direct access to this cheat sheet. But just to hopefully bring everything together in one summary, the basic premise in accordance with our 5 value area principles is that if we are outside of previous value, we are looking for continuation of that bias. So our first 4 examples are all outside of PVA, and we are just looking for, if above the PVA, a bullish bias, and below the PVA, a bearish bias. Now, if we're inside of PVA, as in examples 5 through 8, we are simply looking for reversion. It is important to note, though, that if our entry trigger in any of these setups comes inside the DVA, we are looking to target the DVA mean. However, if our entry trigger comes outside of the DVA, we are looking to ride momentum, or if the trend goes into the PVA mean. For example, here we are inside the PVA and outside the DVA, and our bias pushes us right into the PVA mean. We are just targeting that. That said, there are ways to extend these targets, but that will have to come from your own application of this framework to your system, invalidations as well. However, just one quick note on that, using VWAP as invalidation, technically there is no invalidation from VWAP structure until the bias shifts based on our value principles. So now on to our examples of actual charts. Starting with setup 1, we are trading outside of the PVA +1 and outside of the DVA +1. So here we have a bullish premise given that we are trading above the PVA. You can see I've just taken a line from the PVA's value area high. So now we know that as long as we're trading above this, we have established a bullish context. And for setup 1, we are essentially just looking for opportunities to buy retests of the DVA one, given that we were outside of the PVA one, PVA positive one. So here we have a retest, continuation higher. Here we have a retest, continuation higher. all of these retests of the DVA plus one push us higher, and you can kind of see it. I should have picked a darker color, but you can see it. It's this light blue area that denotes our plus one to the top and our minus one to the bottom, and then the black line in the middle is VWAP. Now, you can see these aren't clean tests, right? And they don't have to be. All key levels are just areas. They're not set prices. You can see that every single time we actually trade inside of the -1, even if we test it, just because we're trading back inside doesn't mean we're invalidated. You can see that each of these times we immediately resume bullish structure. So here we come inside, we make a higher high or higher low, then we break outside again. Then we come back in, higher low. The higher low is actually a retest. Come back in, higher low, back outside. Come back in, higher low, back outside. Come in, retest, come in, higher low, back outside. Come in, immediately trading out. We're never really accepting in here with any sort of shift in structure based on just the price action. So given that, we can reserve our bullish bias. Once again, levels are areas, not set prices. And each of these retests from a price action perspective is evidently valid for continuation. This is our outside +1 inside a retest of -1 DVA. So in our last example, we were outside of the PVA +1 and outside of the DVA +1. Here we're outside of the PVA +1, but inside of the DVA -1. So we have our bullish bias from trading above the previous value area high. And we have a bullish bias from testing into the previous value or the developing value area in -1. So here's an opportunity in this sort of area, and then another one here. Once again, you get a bit of failure here, but it instantly reclaims and then starts trading higher. In this example, we are looking to trade lower as a result of a bearish bias from trading outside of the PVA's -1. And we are also below the DVA's -1, so on retests of it, we can comfortably look for executing on a short bias. You can see we test here and trade lower, we test here, trade lower, test here, which is a bit of a failure, but we never really trade on the other side of VWAP, which, as I said, would technically be the invalidation for this. Now, if you have your own system, ideally you're not having to sit through this and you can just exit and re-enter once you get this breakout side, retest down in this area, or this area, as they all sort of push us lower. Fourth setup we'll look at is being outside of the PVA again, but in this case we are inside retesting the +1 DVA. Once again, levels are areas, not exact prices, so you can count this as a retest in this area. This would be another retest, but this area would be good. This area, all in this area, we're just retesting the +1, which gives us a short bias back to the DVA. And you can actually see how well the level holds. So if you're just accumulating up in here, it keeps coming back, tapping, giving your exits. And then here you get another test. We are short bias from trading below the PVA and short bias from testing into the DVA's +1. Take it back to the DVA mean. Our fifth setup, this is where we are trading inside of the PVA. In this case, since we're trading in the upper half, we can establish a bearish bias in the context of our PVA. And now we are looking for retests of the +1 DVA to come back to the mean. So you have two opportunities here. You have an opportunity in here actually, although this one fails a bit. You have this opportunity here, another one here, and all of these, you take it right back to the mean. Now, like I said, there are opportunities to extend targets. In this case, we know from our 5 principles of value areas that a lot of the time we expect price to rotate up and down through value. So that is something to consider. In this area, we do that pretty cleanly. There's a few more entry opportunities in this area as well. Our sixth setup is another a bearish bias, given that we are trading below the previous value area's high. In this case, we are looking for retests of the developing area's -1 to get short back to the PVA's mean. All these red circles, once again, mark potential entries. Realistically, there's more, but these all serve as good examples. The seventh setup here is a bullish context based on that we are trading inside the bearish zone of the PVA, but above the PVA's -1. In this case, we are looking for a retest of the DVA's -1 to take price back, at least to the mean of our DVA. All these green circles signify long opportunities. In the exact same chart, on the other side, we actually have our eighth setup, which is a bullish context based on trading below the PVA's mean, but above the PVA's -1. All of these green circles are retests of the DVA's +1 and are used as opportunities to revert price back to the PVA's mean. As always, this is not a complete system. It is just a framework that you can use to establish a bias for a system to be built on top of it. For entry triggers, like I said, I look at things related to identifying trap traders. I watch buyer and seller interactions. I look at oscillators, but once again, you can use anything you want. There is edge quite literally everywhere. Anyway, that's the end of the lecture. If you enjoyed it, like and subscribe, as well as follow me on Twitter. My handle is on screen, and there will be a link in the description. There will also be affiliate links for the things that I used in this video. If you found value from this, you can also support my crane eating addiction using that Ethereum address on screen and in the description. Lastly, I have a free trading Discord open to everyone. I'm in there all the time giving feedback and answering questions. You can also get the framework for this cheat sheet in there as well. Anyway, that's it for the video. Thanks for watching. See you all in the books.